right, and we are live. How's it going, friends and family? Hope your day is going pretty well, and if it's not, well, hope you can take your mind off of things as we talk about the stocks. Welcome to another earnings week. And by the way, this one's going to be a little more laid back. It's basically a podcast of all the stocks to keep an eye out for this upcoming week. And if you make it through this entire video and don't learn at least one new thing, I will personally give you a haircut. And between you and me, it's one of my more favorite videos to make. Because honestly, it's something that I do every Sunday, whether I'm recording or not. So I decided to just turn on the camera and, just document my thoughts and opinions. And in case you missed it, some notes about the channel. These are the videos that were uploaded recently. Number one, a data-driven analysis of the NASDAQ 100 income ETFs. I rank them best to worst. And number two, I also uploaded episode 3 of the public portfolio series. And in that video, we covered 3 different topics. And then last but not least, I also posted on the Patreon the 3 opportunities that I'm currently watching in the market. High risk, high reward. It's very uncharacteristic of me, but if you're into that, check out the Patreon. So what do we've got going on this week? As you can see on your screen right now, there's big retail brands that are reporting their earnings. And by the way, let me just pump the brakes. If you don't know what I mean when I say earnings, it's essentially what a publicly traded company does every 90 days. They tell us the financial progress of their operations, but they also give us an update to their guidance, their future, and how things are going to be in the next 3 months. So it's really important, and it would behoove of you to pay attention, especially if you're invested into individual stocks. Having said that, the big retail brands that are reporting, we have Dick's Sporting Goods on Thursday. There's also Ulta Beauty. There's also Kohl's. And based on what Walmart and Target have said in recent weeks from their earnings, for retail spending, believe it or not, it's business as usual for the most part. However, consumers are buying less unnecessary items. And then there's also quite a few software stocks that are going to be reporting, including Oracle, Adobe, UiPath, SentinelOne, Service Titan, right there, a vertical tier 3, and then Rubrik. Between you and me, when it comes to Adobe on Thursday after the markets close, I think they're either going to skyrocket or go down to $149 a share. Nothing in between. Now that's the week in a high level, and now we're going to go through each day of the week in a deeper format. And let's kick things off on Monday. I think right off the bat, a company that I'm personally going to be paying attention to is Casey's General Stores. I'll be honest with you, this is a company that I just found out about in the past year. They've been on my watch list ever since, but the buying opportunity for them never comes. And they're essentially like a Wawa's or a Buc-ee's. It's a gas station, but it's a one-stop shop because you go inside the convenience store aspect of it to get their pre-packaged or pre-made foods, and it's actually giving Domino's a run for their money. I'm not joking. Their pizza apparently is really good. Case in point, if we zoom out 5 years, their share price appreciation alone is 226% in 5 years. Guys, that's the definition of a compounder. You take a look at their financials and everything else, it is ridiculously high quality, which is kind of crazy to say coming from a gas station, right? A gas station business operation. That's why I say it all the time. There's hidden gems and high quality compounders in every single sector and industry. I'm not exaggerating when I say that. Me personally, I do not like the pharmaceutical space because of the outrageous amount of R&D and the patents that expire, and then the lack of an economic moat once it expires. It's not a space that I'm comfortable with investing into. It's literally like a casino and a lottery, especially with the drugs and the pipeline. Having said that, even Eli Lilly, I would invest into. Best in class in the pharma space. You look left and right, there's money to be made in every area. Case in point, Casey's, right? This is a phenomenal business. Hop on over to their free cash flow. Check this out. I mean, just look at that, right? 2016 was $79 million. Now it's $500 million, $682 million of free cash flow. Break that down on a per share basis. I mean, it gets even better. $18.26 of free cash flow per share. And then check out their dividend profile. This is where you should be salivating, right? The dividend growth rate is 14%. I mean, the dividend yield, nothing to write home about, but the payout ratio being 13%, absolutely sustainable, juicy, beautiful. If you take a look at it visually depicted, I mean, obviously during the pandemic, I think it was a little stagnant, but they still raised it and they grew it. So this is a company where if there's any sign of weakness or the market's punished them, I would love to jump in. But I'm going to tell you right now, in the past 12 months, I have not had that opportunity. So I don't see that happening. And collapse that right there. What else do we've got on Monday? We've got Zim, the shipping cargo service with the ridiculous dividend yield. I think this is one of the first yield traps that I was exposed to on the market because at the time they had like a 40-50% dividend yield, but over time their share price has just eroded beyond belief to the point where I just don't understand why you would want to invest into Zim. There's Korn Ferry. Let's see. They're basically in the business of headhunting, helping you find your next executive C-suite. And they also have like some psychology-based leadership style surveys and everything else. I mean, personally, I'm not bullish about that. I feel like if AI is going to disrupt any industry, it has to be the staffing, employment, but also the people that are administrating and proctoring, those leadership type of exams or surveys. Yeah, just not feeling that one. And as we trickle on down, I think small caps, we can hop on over to Tuesday. There's Oracle. This is one that's on my watch list. The Patreon family already knows what price I'm trying to jump in. I'm personally bullish about them. Now, obviously, out of the they're not a Mag 7 constituent, right? I would say out of the ones that are kind of like the Mag 7, like Broadcom and Oracle, just like the Ivy League, right? It's an athletic conference, but can't we also introduce Stanford, MIT as a quote-unquote Ivy, right? So Oracle to me is kind of like a Mag 7, but one thing that I really don't like about them is if you take a look at, if you hop on over to the balance sheet and you take a look at their total debt, which is how leveraged they are, just look at that, right? Year over year, it's only getting higher and higher and higher, $131 billion of debt. And it makes sense, right? Because they're pivoting their business model from just being the enterprise backbone software company to now also supporting OpenAI with data servers and data centers. And that requires a crap ton of CapEx. If you take a look at the cash flow statement, capital expenditures, look at that. In, the start of the pandemic, $1.5 billion of CapEx. It's not too crazy, about in line with what they were previously spending. And then the trailing 12 months, can you just take a look at how much CapEx we're talking about, friends and family? $35.4 billion of CapEx. That's disgusting. That's almost horrific. But again, the reason why I'm bullish about them is unlike the narrative that's going around on the internet, I'm actually very bullish about OpenAI. I don't think they're just going to let their foot off the gas pedal and allow Google's Gemini and Microsoft's Copilot and Elon Musk's Grok to just win the LLM race, right? I think OpenAI, especially with their new partnership with the DoD and everything else, super bullish. But also their stake in TikTok, right? I think they own 16, 18% of TikTok. And that's probably the fastest growing social media platform here in the US. Personally, do not use it. It is the definition of a brain rot app, just like Duolingo, right? They gamify the process where you don't want to swipe away. Or I guess that's the entire algorithm. You just keep swiping. You don't actually pick and choose. They curate and just catalog content to keep you on the platform. Literally the definition of brain rot. Like, you'll see half-naked people, you'll see rage bait, you'll see stuff that makes you emotionally, I guess, disappointed, because when you invoke negativity in people, outrage, it makes you stay on a platform longer. It's psychology. Personally, I'm not going to let my daughter download TikTok as she gets older because I think it's really bad. But as a business operation and the amount of money that they're making through ads and everything else, TikTok, very bullish. And I think the key metrics to look out for is going to be their cloud revenue growth, otherwise referred to as their OCI, and also the guidance on their CapEx. If it goes any higher than what Wall Street's already anticipating, then I think the stock's going to go on a sell-off. Me, personally, I'm going to be jumping in. I'm not trying to tell anyone else what to do with your money. Me, I'm buying in, because I have their fair value estimate at a much higher price than what they are right now. And I'm not trying to say just because they fell off a cliff from being $300 a share back in September that they ought to be back there. I'm not insinuating that at all. But based on their future, right, and their partnership with OpenAI and their ownership in TikTok, dude, I'm really bullish on Oracle. And I know it doesn't make any sense given their financials and fundamentals being really weak. However, I think it's one of those things where it's like they're betting on themselves right now, right? And I think it's going to pay a crap ton of dividends in the future. Obviously, that's a lot of speculation. That's a lot of narrative. So I can see why a lot of people would want to turn a blind eye towards them, because it's not really a safe and steady kind of a voyage. And then also on Tuesday, we have NIO reporting their earnings. I'm personally not going to invest into Chinese stocks, but apparently from my understanding, they've now have taken the number one market share of the most EVs sold worldwide. So I think places like Europe, Australia, Canada, and all parts of Asia, they're really opening up to idea of buying a Chinese EV for a fraction of the cost of a Tesla EV. And I don't think Tesla cares, because I think Elon already made the pivot, and he's already transitioning some of his manufacturing facilities here in the US to now making his robot. I think it's called like Optimus. Could be wrong. What is it? Optimus Prime? Something like that. He's not even trying to be in the business of cars anymore. He's trying to go into like all out into humanoid robots. So, yeah. And then there's also AeroVironment. This is a company that I guarantee none of you have heard of before. They essentially make, for lack of better words, this might not be kosher to say, but kamikaze drones. So essentially, you'll drive, or I guess fly it into a one-way mission to never return. You can kind of put the pieces together to see like what I mean by that. And with everything going on in the world right now, you know, this company, it looks like it's going to be a major beneficiary of modern warfare. So I think drones and robots, I think it's slowly taking the place of boots on the ground. Obviously, as a former infantry officer, I don't ever think humans will not be involved, but it's drastically reducing the amount of bodies needed on the ground, if that makes sense. And this is a company that I'm kind of watching, but not really, because when it comes to the drone space, there's a handful of other drone players that I'm interested in before I even consider AeroVironment. Lockheed Martin being number one, Kratos being number two. But, I mean, it is still a military stock. And the metric that I'm going to be watching as they report their earnings is the backlog. Because any company that does a lot of business with the military, it's all about the backlog, right? And if you take a look at the amount of money in their gross sales, it is just ridiculous. 80% growth in their gross sales in the past 12 months. And that's why I really love business operations that partner with the DoD. Other government agencies, there's ebbs and flows, really depending on the budget. But one thing that I understand about the DoD is that the amount of money that we spend on tanks, on submarines, on drones, on weapons, on missiles, that budget only goes up and to the right. So that's why I really like the military stocks. Because even if there's an 80% growth, it's not going to be slowing down, especially if you take a look at the landscape of modern warfare. And then another one on Tuesday. This is a company that I've been trying to buy into for the past 2 to 3 years. They're basically in the business of providing a whole bunch of different services in order to maintain a building, a warehouse, a facility, and I guess that's a really pretty way of saying janitorial services for the most part. And if you take a look at their dividend profile, 59 years of consistent growth in their dividend. 2.6% dividend yield, 15% dividend growth rate. I'm not invested into them, by the way. It's a company that I want to be invested into, but based on my understanding of what's happening in the US, I live in Japan. But if you can't tell by my accent, dude, I'm American as heck, okay? I've been watching the news here and there. I mean, I like to follow the Wall Street Journal and The Economist, especially with the economy and different startups, venture capital, fundraising and stuff like that. But I also tune in to the stuff that's happening on on a political level as well. And what I saw is that a lot of undocumented immigrants are getting kicked out of the U.S. Right? I think there are some bad guys, but I think a lot of the good ones are also being kicked out. Kind of sad to see, to be honest with you. But when you think about ABM and you think about janitorial services, I'm not trying to insinuate anything, but I feel like a lot of their staff and employees are probably going to fall under that category, just like I'm not trying to make any accusations or generalizations, but when it comes to Western Union and people that are depositing physical cash so that they can send some money orders back home to Peru, Ecuador, their biggest clientele and customer demographic is also the undocumented immigrants, because for the most part, if you're able to get documented and you have a visa, then you can just open up a bank account and send money digitally, right? Venmo or PayPal or what have you. But if you're not documented, then you have to go to a service that is kind of like a bank, but doesn't require you to be a permanent resident. Likewise, if you take a look at what's happening to Western Union, that's one of the key drivers as to why their business model is suffering really hard under the current administration. I mean, the gross sales is dropping off a cliff because as more and more undocumented folks are getting kicked out of the U.S., this business model cannot live, cannot survive, cannot sustain itself. Likewise, when it comes to ABM, that's one red flag that I need to investigate a little bit further. I mean, it's hard to tell, right? Like, you can't see it in their 10K. You can't see it in their investor slide deck. So it's one of those things where you got to read between the lines to figure out if that is something that affects them or not. Because if they do have a staffing shortage, then they can't be good on their end of the bargain and cleaning out, trash bins, cleaning bathrooms and whatnot. That means they're not going to get paid. So yeah, there's ABM. I think I said a lot about this one, a company that you guys probably don't care about. So hopping back over to Tuesday, what else do we have? Let me just close this right here. Kodiak. There's UNFI. This is a company that's headquartered in Minnesota, and they make the private label food brands for kind of like the bougie organic grocery chains. Not really a fan of this one, I'll be honest with you. Same with Kohl's. Well, this is a company that I think a lot of people just kind of dismissed for good reasons, but take a look at what happened to them not too long ago. In the end of November, they went from $15 a share and they skyrocketed to like $25. So this is, it's really mean to say, but Kohl's is now in the meme stock territory. It's super volatile and it just moves up and down irrationally to the point where I never would want to go near them. Personally, I'm not really a Kohl's kind of guy. I shop at, when I used to live in the U.S., I used to shop predominantly at Costco, Target, and sometimes at like Marshall's, TJ Maxx. But from my understanding, Kohl's is a good place to buy, I guess, like pajamas, clothes for your family, stuff like that. And let's see. Anything else here on Tuesday? There's Groupon, which I don't understand how they're still in business. Let me just take, oh my goodness gracious. Since 2016, their gross sales has just been declining. Like, who's investing into this? If you're investing into Groupon, I truly don't understand you. You're probably the same type of person that takes a dump after taking a shower. Like, after you're all clean, then you take a dump. Like, why would you invest into this? So Groupon is essentially an online website where it gives you offers, coupons, and promotions to stuff that's happening in your general area. So I personally used to use Groupon a lot when I was in college in 2010, 2011, when I would go home for the summers from the military academy and I would need like a 2-week or a 1-month gym membership. I would go on Groupon to get a offer that's like 50% off and specifically catered to college students. And then, yeah, it would work out. But, dude, I think after 2011, I don't think I've ever gone back to using Groupon. This is a company I genuinely do not understand why anyone would put any of their money. Why would you put your money anywhere near Groupon? Past 1 year, 14.5%. You got to be kidding me. Their trading multiple based on their forward EPS is a 22. Guys, I don't know. Maybe I'm being a little harsh here. I don't want to be too negative. Let's just move on. Anybody else? Anyways, let's go to Wednesday. We have Campbell, Food CPG. There's UiPath. I think they're tier 4 SaaS company. If you have no idea what I'm talking about when I say tier 3, tier 4, go and watch my software stocks landscape video. I spent 2 weeks doing the research and an analysis to figure out which software stocks are going to be durable, are going to make a comeback, are going to be high quality, and be the, I suppose, ride the wave of AI instead of being obsolete by vibe coding. So I think that video is super important to watch because companies like UiPath, I'm personally very bearish about. There's Chagi Holdings, which is they make boba tea, milk tea. It's a chain. But again, this is a company that I do not want to invest into because they do not have an economic moat. Same reason why I sold out of Starbucks. And because when you look at the landscape of coffee, I was listening to an article by the Wall Street Journal. More and more retailers are opening up their own cafes and coffee shops because the studies have shown that if someone, a Patreon, a shopper is able to drink a cup of coffee while they shop, they're willing to spend 22% more per visit. And so they're cutting ties and they're not even saying, hey, Starbucks, do you want to open one up here? Now they're just opening up their own little coffee shop in the corner of the shopping mall, in the corner of the department store. And then when you look at the coffee landscape, there's so much competition, right? Dutch Bros, there's Luckin Coffee, there's what's that Canadian one that's a franchise under the same company for Popeyes, Burger King. I don't know. I think it's called like Tully's, something like that. Coffee, there's literally no economic moat. And then McDonald's just entered the coffee game as well with Cosmic or whatever it's called, strictly just for drinks and beverages. Likewise with the Chinese milk tea, I think it's a huge fad. It's trending. It's hot right now, especially in the U.S. But once again, I just don't see an economic moat. There's Wealthfront. It's one of those robo-advisor brokerage providers based on my understanding from 2019. To be honest, why use a robo-advisor, right? My whole thing is like, you might be better off just doing SCHD, VOO, call it a day, and you'll outperform every robo-advisor out there. That's not financial advice. That's literally almost objective truth. Oh, there's a really good one. There's Serve Robotics. I made a dedicated deep dive video talking about them on the channel. Here, click on it. Not too long ago. And they're basically in the business of selling, or I guess manufacturing and selling as a rental service, these little robots that drive on behalf of DoorDash, Uber Eats, and other, restaurant delivery apps instead of using humans. So they basically make money from DoorDash and all these other places paying them every month to be able to use their robots for ongoing support, maintenance, but also software upgrades. This is one of those speculative bets on the future of robotics. And I think the only metric that matters here, because if you take a look at it, I guess based on their top line, it's a compelling story, a 700% increase year over year. But then for the trailing 12 months, we're only talking about 15%. So there seems to be a little bit of a sluggish speed bump, which we talk about in the deep dive video for them. But the only metric that truly matters for them is the number of robots deployed, because the leadership team promised 2,000 robots actively out there making and generating money on behalf of the company. And if it's anything short of that, this stock will go on a very, very steep sell-off, because they're obviously unprofitable, right? You're not buying into them for something that is predictable, that's generating cash flow. You're buying into them for their future based on hype, based on the tangible amount of robots making money. Because based on my research, to give you a little bit of a hint from the deep dive video, even if they have 3,000 robots, at any given time, they can only utilize 1/3 or like 35% of the robots to make money because of the downtime of repairing, fixing, and maintaining the other robots. So in a perfect world, they could have like 5,000 robots right now making money, but because of the labor-intensive manual portion of running the business, of fixing the wheels, fixing the whatever it is, they can only truly make money from 1/3 of their fleet. In comparison, if you take a look at like UPS, FedEx, or Walmart or Amazon, on any given moment, about 80 to 90% of their trucks, their airplanes, their cargo vehicles, whatever you want to say, is generating money. So the fact that Serve Robotics, and that's because, again, another hint from the deep dive video, my biggest gripe, my biggest complaint when it comes to Serve Robotics is their leadership team, they're all brilliant, right? They're all engineers, they're all really computer tech wizards, but not a single soul up there has any experience in manufacturing, any experience in supply chain, any experience in operations. So for me, as a potential investor, I wouldn't go near them. You have a bunch of really smart people that know how to design and make a robot, but not a single soul that knows how to maximize the throughput. Does that make sense? And that's why I think they're running into the bottleneck of only 33% of the robots being actively out there. And that's why I think when you make a business, don't do it with friends. Don't do it with your family members. Do it with a stakeholder from each realm or sphere that's an expert in that territory. Have someone on the team that's a really good finance guy. Have someone on the team that's really good taking care of the human capital, HR. Have a person on the team that's really good with supply chain manufacturing. Have a person on the team that's he's like a wizard when it comes to marketing and generating leads and sales, right? If you have just the same personality, the same expertise, the same line of sight, you have just a bunch of engineers running this company, I don't know, man. I would just hesitate and pump the brakes. That's all I would say. Now, obviously, what I just said doesn't really make sense if it comes to like a very asset-light software company, but Serve Robotics, they're in the business of making and selling robots, right? A tangible physical good. So if you're trying to run a business with physical services or physical products, then what I just said, I think, is sound advice. But obviously, if it's like a web designing team or a wedding catering service where you make, like, obviously it doesn't really matter, right? You just need a bunch of software developers so you can create a platform in which that can happen. But I guess if you do it on the physical side of wedding services, I guess the advice still holds true, because then you're going to want someone that knows how to make a really good cake, someone that's really good with setting up tables, someone that's really good. You know what I'm saying? All right, but anyways, let's see what else we got. And as we scroll down, we have Bumble. And I think I told you guys one of my business ideas that I'm probably never going to execute. So Bumble's in the business of online dating. They help people meet. I think they're the parent company of Coffee and a Bagel. Let me see. Does it say Badoo, Bumble? I'm not sure if they're the parent company of Coffee and Bagel. But anyways, they're in the business of helping people meet, just like Tinder, just like Grindr. And between you and me, my business idea is this. Instead of deviating and defaulting to doing everything online, I think more and more people, they're craving real connections, real relationships, that face-to-face intimacy, right? So I was thinking of opening up like pop-up shops around major metropolitan cities like Detroit, Baltimore, Los Angeles, San Diego, speed dating with preset questions, a modality in which it's standardized. That way it's not awkward. That way it's not, I guess, everyone gets a similar experience. Fun questions to ask the person in front of you, 5 to 10 minute timers. You move on to the next one on a rotational basis, and you would charge per person, per head walking in through the doors. There'd be a cubby or a locker set up where they put their phone in. You can't have access to it. You got to do it the old-fashioned way, get to know each other. If you're not interested, you can press the buzzer that allows you to go into a different, I guess, roped off area, and you have to wait until the timer's up for everyone else. And there you can mingle and try to do, I guess, a freestyle. If you see someone that you like, maybe you can strike up a conversation. If you don't, you could just wait it out, watch how other people engage. That's one thing that I wouldn't mind doing, but I have so much going on right now, especially with raising a baby, running this YouTube channel full time, that I'm never going to execute that one. I also thought about doing a subscription-based car wash that also is a donut shop. That one I'm probably never going to execute as well. Go ahead, feel free to steal these ideas. Just bring me on as a board of director, or I don't know, right? But Bumble, I would never invest into them. I think when it comes to these online dating apps, I think people are meeting online, but I'm trying to tell you guys, there's going to be a renaissance of people trying to do things the old-fashioned way. And I think in-person dating events, it's going to be all the rage in the next 10 years. I'm calling it right now. Move on to Thursday. There's Adobe. I know, there's a lot of you guys that are invested into them. I personally used to be bullish about them. And I think all of that changed once I conducted my software landscape research in order to make that video about tier 1 all the way to tier 4. And it sucks to admit I was wrong. Like, I was bullish about them until I did my research, and then I was like, well, crap. I see it. I think Adobe, I really don't want to step on any toes, especially if you have a weird, funky smelling toenail, but I think their best days are behind them. When you think about their future, when you think about the next 5 years, 10 years out, dude, I think Adobe, I know you guys hate it when I make this parallel. They really remind me of PayPal. Very established, very mature, and what's their growth catalyst, right? So, yeah, Adobe's one where I changed my opinion. I'm not going anywhere near. As a matter of fact, you can't even pay me to invest into them. There's far better opportunities and far better deals in the software landscape before I would even consider Adobe. There's also Dollar General. Think of them as the Walmart for underserved communities and rural areas. Did you know that? There's basically a Walmart within like 85%, something like that, of the US population within 15 minutes. The other 15% of the Americans, Walmart does not want to cater to. Why? Because it doesn't make sense on a business level. The margins for that store, it wouldn't be enough for the P&L to keep the lights on. And that's where Dollar General comes into the picture. So you'll basically see a Dollar General in the middle of nowhere. You'll see them in rural areas near Native American reservations. You'll see them in parts of Montana, North Dakota, places like that. And so they essentially have a monopoly if you think about it. Because if you're from a very small village, community, or neighborhood, and all you have is a Dollar General, you better bet that you're going to do all of your grocery shopping there. You're going to get all of your needs there. Because, yeah, you can get it on Amazon, but when it comes to stuff like essentials, groceries, frozen food, yeah, you're going to have to go through Dollar General. I mean, does that mean I'm going to invest into them? No, I'm just telling you that they have a very solid economic moat. And changing gears a little bit, when we talk about the cybersecurity landscape, there's a player that's in the tier 4, unfortunately, that I really like, but I'm also very scared to go near because they're in that scaling hyper growth phase of their business. What I mean by that is their top line increasing by 49% year over year. But if you take a look at their earnings per share, it's only been negative since their inception, right? As of right now, it's negative $1.95 of profits per share. They're losing money to keep the lights on. This is a company that I really like. They're tier 4, but their whole business model is predicated upon the fact that they're not trying to prevent people from hacking into your servers or into your organization. Their business model is already betting that you are going to get hacked, but they're going to secure that data so that when you get hacked, the hackers can only access high-level stuff that's public information. They won't be able to steal passwords or confidential info or data. Does that make sense? So it's like a really interesting premise in the landscape of cybersecurity. So this is one that I want to go near, but if you take a look at it, what I'm seeing right here, they don't even have a PE ratio because you can't calculate a PE ratio unless you have a positive EPS, right? So for that reason alone, I just don't want to go near them. However, having said that, I think there's a price for almost anything in this world, right? Me personally, I think if they go below $40 because they pooped their pants during the earnings, I think that's where I might be open to the idea of jumping in. Contingent upon nothing else going too crazy. Like if they say, hey, we're going to quit the business of cybersecurity and open up a shop that's going to be selling socks from here on out, obviously not. But let's just say their guidance going forward is like, I don't know, 45% growth, but Wall Street was expecting 46% growth, and they go on a 20-30% sell-off. For me, I feel like that's really emotional, and that's when I would contemplate jumping in, if that makes sense. And then here's another software landscape video. Service Titan, Tier 3. They're basically a one-stop shop for the folks that are in the business of HVAC, plumbing, lawn maintenance. They take care of everything. I'm not exaggerating when I say that. This is one of the companies that I was really considering jumping in during the whole software sell-off, but I did not. Instead, I went with Microsoft. And I think in the long run, I think Microsoft was going to be the right call. But it is kind of, I do get a little bit of FOMO seeing the 35% increase since their bottom of the sell-off. But it just goes to show, I think the market's starting to wake up and realize that not all software stocks are disgusting and gross. Some of them are better positioned to thrive. I'm serious right now. If you have not watched my software landscapes video, you have to. I promise you, you will learn so much from that video. And if you do not, come back, comment, and I will personally clip your toenails and give you a back rub. I will. It is not going to be a waste of your time. And then let's see if there's anything else. There's another one right here, a drone aviation company. I think they're in the business of making not exactly drones for warfare, but drones to transport people from rooftop to rooftop. That's based on my research from 2019. Now, I could be wrong, but that's what I remember from back then. Wow, I did not know this is a publicly traded company, Angel Studios. This is the company that was responsible for making that hit series, The Chosen. Wow, that's pretty crazy. I didn't know they were publicly traded. But, yeah, I guess you learn something new every day, right? Water Drop, Build-A-Bear workshops. I'm telling you right now, if you have a child, if you have a nephew, a niece, whatever, you can take them on their birthday to Build-A-Bear workshop, and you only have to pay how old they are. So if your kid is like 3 years old, you can make them a customized teddy bear with memories that you guys can look back on together 20, 30 years from now. Like, even if you're a grandparent, right? If you have a grandchild, take them there, get a bear made, and it'll only cost $3 if they're 3 years old, right? 5 years old, then it'll be $5. Super good idea. And I heard that their stock price has been rallying. I listened to this Wall Street Journal article talking about how they're making a comeback. People are specifically going to shopping malls and just to go build a bear, which is kind of crazy to see. So if you take a look at their performance in the past 5 years, 490% into the green. That's why I keep saying, like the stock market, you feel like you're able to predict who's going to thrive and who's going to die, but you really can't. If you were to ask me in 2021 how I would feel about Build-A-Bear Workshop, I would say no. I would not want to invest into them. But I don't know, guys. I guess the American teddy bear is making a comeback. I mean, me personally, would I want to invest into them? That's absolutely no. No, I would not. But when it comes to getting a teddy bear made for my daughter, absolutely going to be doing it when she turns, I don't know, 1 or 2 years old. And then that's way too small caps, so we'll avoid that altogether. And then Friday, there's Fizz. That's the parent company of LaCroix. Honestly, in the beverage landscape, my personal favorite is probably Keurig Dr. Pepper, and then number 2 would be Coca-Cola, and then PepsiCo. And then I think Fizz would be in 4th place for me. Now, obviously, I'm not talking about the energy drink makers, because if you introduce them into the mix, then I think it gets a little crazy, a little wild. But, yeah, that just about wraps it up. I don't really see anything else that's worthy of our attention. So, having said that, hope you guys enjoyed this one. Hopefully you learned a thing or two. And I will talk to you next time. Stay safe. Good luck in the stock market. Love you.